Good morning. I'm Gord Long with the Financial Repression Authority. As part of our ongoing series on investing based on the Austrian School of Economics, I have Robert Wenzel joining us this morning. Robert is editor and publisher of the economicpolicyjournal.com and Target Liberty. He also hosts the weekly podcast, The Robert Wenzel Show. Welcome back, Robert.
Hi, Gordon. Good to see you.
Yeah, it's nice to have you back. It's been a year. I just realized how quickly time goes.
Yeah, has it been that long? Wow.
So we're both busy.
You know, and the Federal Reserve is still in power. What's the deal?
And somehow everything's changed, but some things have not changed at all. Robert, a lot of we have so many new listeners. They may not be familiar with your background and things you're involved with. Could you just give them an idea of the things you do?
Okay, sure. As you mentioned, I'm publisher of economicpolicyjournal.com, which is a blog that discusses the economy, looks at what's going on with regard to interest rates, Federal Reserve, monetary policy, things along those lines. It's updated 7 days a week throughout the day, so there's always new information there. Target Liberty is aimed more at libertarian type discussions and what is going on with regard to government interference with liberty and philosophical thoughts about liberty and things of that nature. I also have published a book. I gave a speech at the Federal Reserve, and the book essentially puts the entire speech in the book and gives some background on it. That's called The Fed FLUNKS, my speech at the New York Federal Reserve. And that created quite a stir when I was there, because I gave them the Austrian school perspective on what I thought of the Federal Reserve, and it's a fun book. And I'm actually coming out with a collection of essays that should be out in the next few weeks that will include topics with regard to economics and also liberty, some that have appeared on Economic Policy Journal. I've been publishing Economic Policy Journal for over 7 years now, and also some new essays with regard to the immigration question, which is a hot topic right now. What's going on with the police and the killings, and how we should really look at that and understand that. So I'm a pretty busy guy, and I'm located here in San Francisco, which is why it's dark in my background right now, Gordon.
Yeah, I apologize having to get you up so early here this morning, but
as I mentioned, I hate sleep, so not a big problem.
Albert, let's just jump right into this, and that is on the Austrian School of Economics. How would you describe it to somebody not familiar with it?
Okay, the key to Austrian economics is what you have with most mainstream economists is they look at things from a very mathematical approach, very empirical approach, very much the way scientists look at, say, the field of physics. You put X amount of gasoline into a rocket ship, and you're going to be able to predict exactly how far that rocket ship is going to go. You can't really do that in the science of economics, because you have so many variables. You're dealing with humans and changes and desires and actions and things like that. So the Austrian school tends to object to that. And the Austrian school, I should mention, is called the Austrian school because the first thinkers in the school were from Austria. And since then, it's gone pretty much worldwide with a large following here in the United States. So the first key is you've got to really watch out for a lot of empirical studies, a lot of mathematical stuff where the sort of mainstream non-Austrian economists will tend to try and mimic the physical sciences. And Friedrich von Hayek, a Nobel Prize winner in economics, who was one of the main Austrian school economists in the late 20th century, said that what economists who were using this much math were doing, they were had an inferiority complex. And we tend to agree with that. We think that there's a lot that can be understood about the economy based on logical build-up from very solid premises. One thing we're very, very good on is the business cycle. We have a theory called the Austrian school business cycle theory. As a matter of fact, There's a great Austrian economist by the name of Mario Rothbard, and he wrote a great section in a book called Austrian School Business Cycle Theory, which I've got the permission to print separately. I wrote an introduction to that in detail about the Austrian school, which explains it, the famous economists that are part of it and where we're going. But the key with the Austrian school business cycle theory is we believe that when the Federal Reserve pumps money into the economy, this is pretty basic, but there are very few people outside the Austrian school that recognize this and act on it. So what we do is we believe that when the Federal Reserve pumps money into a certain sector of the economy, those are the sectors that are going to boom. And it tends to be the capital goods sectors because the money generally goes through the banking system. So what you see during the boom phase, you see strength in the stock market, you see strength in real estate, which is what we saw before the 2008 crash. And again, what we're starting to see now. Here in San Francisco, Silicon Valley, you're getting a lot of the new money coming in here. And this is a boom area. Rents are out of control. Salaries for jobs are out of control. It's a really remarkable period. But because the Federal Reserve it's a manipulated boom, and this money is going out into the system. When the Federal Reserve stops, which they tend to do at different periods, when inflation eventually heats up, price inflation, when the price inflation starts to heat up, then they sort of clamp down on the money they're pumping out, and then you have the crash. And specifically, I did live on my blog at economicpolicyjournal.com in 2008, in the summer, before we had the financial crisis in September. I said, I can't believe Bernanke is tightening money this much, where we're headed for a Great Depression type crash. And, he really clearly, from his Federal Reserve perspective, doesn't know what's going on, isn't watching this, and the crisis happened. That's part of why I was invited to the New York Federal Reserve to discuss my forecasts at that time. Now we're in a period when we're actually going into accelerating money supply. So there's a lot of people that expect a downturn short term here in the economy developing, but I don't necessarily see that. I think the great problem for the economy in the near future will be a surprise increase in price inflation. Some of that, as far as the government index numbers are concerned. Now, there's some people that question the government index numbers, but what I'm saying is inflation is going to be so bad that even the government price indexes will detect it. Now, the only thing that may slow this down, we've had a tremendous drop in oil. There's a lot of supply of oil. All the tankers are full right now. So there's a possibility of another down dip in oil, which might slow the eventual price inflation by 6 months or so because of that factor. But I think price inflation is the major surprise thing going into 2016.
Now, Robert, the Austrians would point out that we get price inflation when we increase the money supply, increase credit as a form of money, which we've clearly been doing at unprecedented levels, yet the velocity of money is falling. And we clearly have inflation in some areas, but not broad-based. We clearly have deflation in other areas. How would the Austrians explain that?
Yeah, that's really an excellent question. And that sort of explains the difference between us and what's known as the Chicago School, which is Milton Friedman. Because Milton Friedman does that mathematical stuff. He tends to, or did, he's since passed away. But with his theory, he suggested that anytime you increase the money supply, you're going to get price inflation right away. And that's because he can only do things where he's measuring numbers and all that. We say, well, that there's another factor here. It depends upon how quickly people are spending money. If there's a great desire to hold cash, then you're not going to see that inflation right away. And what you tend to see after a major financial crisis, you saw it after 1929 going into the Great Depression of 1930, and you saw it again after the financial crisis of 2008. People are in fear. They're fear that they're going to lose their jobs. They don't know what's going to happen. So they tend to husband their cash more. So they get new money, and then there's some people that are unemployed and they have to find new jobs. But all this combined causes people to be extraordinarily cautious with the cash they have, so they don't spend it as quickly and as aggressively. So you have all this money sort of building up in cash balances, and I just call it the desire to hold cash balances. And that's been low, and that's what that velocity number is all about. The money supply has been increasing, but the amount of spending relative to cash balances has not. Now, at some point, I expect that to turn around. Once people start to see that prices are going up fairly regularly and quickly across the board, then what you're going to see is people wanting to spend money quicker before prices go up. You have the opposite now. You have fear. It's coming out of the fear. The unemployment is improving. New York, Washington, D.C., San Francisco are boom areas, and that's a sign that we're headed more towards price inflation now.
People tell me all the time that things just seem so confusing and nothing seems to make any sense what's going on economically. And they're often describing the difference between Wall Street and Main Street and what appears to be some level of disconnect. But understanding the Austrian school suddenly allows a lot of things to be very, very clear. And so understanding, as you point out, the business cycle, under the Austrian business cycle, understanding the what causes inflation. Are there other key elements of the Austrian school that if people understood those, would help make sense of today's world, especially in an era of financial repression?
Yeah, well, the key, it's very important to understand the Austrian school business cycle, because that's unique. And then it's also more from a theoretical perspective to understand how the Austrian methodology is different from the mainstream with regard to looking at things from a logical analysis versus just sort of looking at empirical data. That's important. But there are other things that even mainstream economists would look at that can you help you understand. One thing, for example, is, and you're seeing a lot of this now, a lot of advocates want to increase the minimum wage. Well, I would say 90% of the economists would agree that when you increase the minimum wage, what that does is it makes it extremely difficult for low-skilled people to get jobs, because no one's going to hire somebody at $15 if they're only going to be able to generate $12 in revenue or something like that. So if people understood that, that would sort of free up a lot of the unemployment you see among youth. You see it among black youth, because then you have the problem of the way they're educated in government schools on top of everything else. So your youth have high unemployment, black youth have incredibly high unemployment, and that would turn around. But they just don't get those entry jobs. They end up hanging out in the streets, getting in trouble, and things along those natures. So your crime would stop, or not stop completely, but certainly be a lot less. These kids would become more productive and all that kind of stuff. People don't realize how destructive the minimum wage is. Unemployment insurance, you pay people not to work. There's going to be a lot of people that are not going to work. So you have these long periods of unemployment insurance that are extended, and that sort of starts to happen. Another thing, and again, this is not Austrian. There's a lot of economists will discuss this, but Social Security, Medicare, all these programs they can't possibly pay out the money they've promised to pay out in the years ahead. So they're either going to have to print money to do it, which is going to be even more inflationary. They're going to have to cut people's pensions and healthcare services and things along those lines. If an insurance company tried to do this in the private sector, those guys would be in jail. What the government did is they took all the money, spent it, and promised to pay it back. If an insurance company did that, they would all be in jail. Bernie Madoff is basically in jail for the same kind of thing. It's insane, but because people don't understand what's really going on, if they really did, this would all be stopped. So economic education in general is extremely important, especially with regard to how the government is involved and intervenes in the economy.
Yeah, Bernie Madoff got more than 25 years for something called a Ponzi scheme, and there are days where I try and understand the difference between a Ponzi scheme and PAYCO, which is government accounting. We just we take the money today and we worry about tomorrow, but we've made
Right.
all the commitments and obligations, for
Right.
example, in entitlements. To me, one of the core platforms of the Austrian school is just sound money and understanding what
Right.
sound money policy is.
Mhm.
And if that's the case, how does an Austrian view quantitative easing for 6 years? How does it view the potential of having overt monetary financing, or what's referred to as helicopter money, just
Right.
straight drop, or even the consideration of going to negative nominal rates as a
Right.
possible policy? Comments on that?
Yeah, sure. First of all, as far as quantitative easing, that was a Federal Reserve scam on top of a scam. That was Ben Bernanke at his best, okay? You want a guy that can move the shells around on the table. This is the guy with the being under one of them. And basically, the Federal Reserve is always printing money. They're always inflating. And what quantitative easing did is it created a way for them to specifically go out and with the money they're printing, buy from the government, from Wall Street banksters. Now, there's a lot of legitimate work that is done on Wall Street, so I don't want to tar with too broad a brush with everybody on Wall Street. I think there's good stuff, but there are the bankers that are in cahoots with the Treasury and Federal Reserve. We're talking about Goldman Sachs, J.P. Morgan, people along those lines. And what happened is they had all this bad debt after the real estate crash, and Bernanke came in and sort of called the quantitative easing and bought that, then went in and bought other kinds of long-term debt and all that kind of stuff. But bottom line, what quantitative easing is a method of printing money, and they do it all the time anyways. We could never have another round of quantitative easing, but the Federal Reserve could still print enormous amounts of money. It's Ben Bernanke, shell game talk. There's another guy that belongs in jail. And I should add, he was recently here in San Francisco, and I attended the talk he gave, and he claimed that the Federal Reserve doesn't print money. Then he went into this absurd statement saying, it's the Bureau of Engraving that actually prints the money. Well, yeah, they print the physical money, but who gives them the order to tell them how much to print and where to send it? I mean, the guy's a scam artist.
Yeah, and it isn't anymore really the physical dollars that are printed. It's the credit and flow that's really going, which is orders magnitude more
Correct.
than the physical currency.
Yeah.
We have $6 trillion US out around the world that's not even in physical dollars, but is in terms of credit and higher. But and by the way, you were mentioning the financial crisis and the printing and the mortgage bubble. We're living through that right now, but people don't see it. We have $1 trillion in car loans that are owned by the government. So the government's effectively backing the explosion in car growth. We have $1.3 trillion in student loans, and we have $600 billion of it in something called forbearance, which is a whole discussion, but basically government's holding all this paper.
Right.
So we're printing it. We're continuing to do it, even if it's not appearing fully on the U.S. on the Fed's balance sheet. It's still being put in place. But what about any comments on this potential for negative interest rates as a policy? We have ZIRP right now, which is zero interest rate policy.
Right.
Which taking inflation account, we have real negative interest rates, which help debase currency and government debt. But it isn't working, and now there's discussions of actually going to negative nominal rates, which makes it worse with real. And we've already got $5 trillion in bonds in Europe around the world, trading at negative rates. And is that a potential? And would that mean the war on cash is something that needs to happen to make that happen? Comments?
Yeah, I think it's extremely dangerous. It's based upon the Keynesian idea that is in production goods that help an economy increase, but more so that it is spending that does so. So what they would like to do is put negative rates on to cause people to spend their money. So that means if you've got money in a checking account and some kind of bank account where you are earning interest, suddenly you're being taxed to keep that money there, so you want to spend it crazily. So what they're only doing there is, I talked earlier about the desire to hold cash. That would completely reverse the desire to hold cash. You wouldn't want to hold anything because it's really what negative interest rates are really a tax, is what it is. A tax on holding money. And there's an economist at the Citigroup that has called for it. There's economists at the IMF. In Sweden, they're actually pulling ATMs out of areas, limiting the ATMs because they want everybody to keep the money in the banking system so they can put in these negative interest rates. Now, technically, I do want to emphasize from a very theoretical perspective, it's not really a negative interest rate. It's really what it is a tax, because no one would invest in something where you're going to get a negative yield. So from a very theoretical perspective, it really shouldn't even be called a negative interest rate. It's a tax. It is what it is. And you can have a tiny sort of negative interest rate, which is just sort of the demand for the bank's processing and things like that. But whenever it gets beyond that, it's going to be it's a tax. Walter Block, an Austrian economist, has written an important paper on this, and so that's something they're thinking about. I don't think they're going to actually do it for this round. It really looks like they've got things going in the direction they will, and I believe the Fed will soon raise interest rates by 25 basis points. I actually expect interest rates to climb long term over multiple years, not very quickly, but they'll climb just because there's going to be so much inflation in the system, price inflation. So that's what I expect. But somewhere down the road, I mean, these Keynesians have this crazy idea, and of course, naturally, it just happens that if you eliminate cash and everything's in the banking system, it's much more easy for the government to track everything and tax everything and all that. Just a coincidence, Gordon, that happens.
Absolute coincidence.
Crazy Keynesian theory lines up perfectly with more government observation of what we do in tracking.
If they trap it, and I'll use that word, all in the banking system. In other words, you can't get it out. We're in a cashless society.
Right.
It means you can't have bank runs. And that's that in itself. And of course, with bail-ins, that means they're home free, and we carry the penalty of any major problem. So, if I understand it correct, Robert, there's a potential they'll tax you if you don't spend the money, in terms of negative. They'll tax you when you spend it because it's called sales tax and everything else.
Right.
They'll tax you, in fact, if you make any money with it in terms of capital gains, et cetera. So, really, and an inflation is nothing more than another stealth tax in itself. That's always been considered that way.
Absolutely. You know, it brings to mind that...
that's a bad picture, isn't it?
Yeah. It brings to mind that Beatles song. There was a song, a tax rebellion song they wrote once. You know, if you walk, they're going to tax your feet. If you die, they're going to tax your eyes. You know, I mean, it's where we're at. You know, it's getting worse every day, unfortunately.
And why, Robert? Why is that though? Not the reason they're taxing, but this desperate need for more money. Is it the magnitude of the debt that we keep mounting and trying to just pay the debt?
Yeah. The debt is a problem, but when interest rates start to rise, and I really don't think the Fed will really be able to keep interest rates as low as they are now. They're really not at zero right now. The effective Fed funds rate is about 12%. It was down as low as 1% at one point, but there's two things. There's what the Fed is going to announce as far as their target areas and where the Fed funds actually has been, and they've been sort of moving it up very, very slowly. So I think it will go up further. And the higher it goes, the more expensive it is going to be for the government to finance the debt they have. That's going to be a serious problem. In addition, politicians like to make promises. They like to get people out basically to buy votes. So that's why it's very, very hard for a politician to sort of call for any serious cutbacks in anything, because he knows he's going to lose votes because of that. He knows the lobbyists are not going to fund him, and consequently we have this crazy scheme. It's a political system that's designed to explode at different times.
And my comment on the taxation, relating it to the debt, I mean, I think all our listeners would agree that's obviously part of the real driving force. But maybe what's not as obvious is such a big part of our economy now is living off the government, whether you want to call it crony capitalism, or whatever. But so many industries are protected by regulatories. Their moats and their profit streams are coming from government spending more and more that way. Ever mind the consumers and I say that the public who are living on food stamps, various forms of entitlement programs, disabilities that are government funded, et cetera, et cetera.
Yeah.
So these just are crippling to economy. Where does it end, or how does it end, or what do you
You
see in
know,
your crystal ball?
Gordon, another very, very good question. It just doesn't look good. First of all, I call this Mussolini economics because Mussolini
He,
was in favor of private corporations, but he controlled them, ruled them, made all the rules, very similar to the way things are now. But he was also a big advocate of government health care and was proud of the fact that he insured people against different types of health problems and things like that. So we've got the same thing. How does ends, Gordon? To contemplate the possibilities are just staggering to the mind. Politicians often, when they're in this kind of trouble, want to start wars to get people off the what's going on domestically and sort of gather sort of a national spirit to get everybody to work and ignore the fact that their standard of living is crashing. You could have a hyperinflation if you get the right guy in control of the Federal Reserve, or actually the wrong guy. They're all bad, but a real bad guy. You could have him printing money at incredible rates, and it could end up with the crack up of the dollar. I expect a major crash in the dollar anyways, but you don't know where it ends. We were very close in the 1970s, especially the latter half of 1970s. This guy by the name of G. William Miller, who was Fed chairman, he was a buddy of Jimmy Carter. Jimmy Carter put him in as the Fed chairman, and he had absolutely no clue as to monetary policy or anything like that. And he was pumping the money at an extreme level. Fortunately, the banksters didn't even want that. He was forced out, and Paul Volcker came in, who's a Keynesian, but he understood the problem with the money printing at that time and was a very, very tough, independent guy. Also a very tall guy, 6'7", 6'8", something like that. And he just put on the brakes and stopped the money printing for a long time. Of course, before he left, he started up again in 1982, and then Greenspan came in. And what he did just before Greenspan left is he tightened again. So he gave Greenspan a nice gift, which Austrians recognize. You tighten that money supply, and the stock market's going to go down. So what happened is between 82 and say 86, Volcker started printing money again, and then what you had is Greenspan coming in. So in 1987, early 1987. So in the last 6 months before he left, Volcker tightened the money supply, which we knew as Austrians would cause the crash, which was the October 1987 crash. So I consider that a Paul Volcker gift to Alan Greenspan. Here, deal with this. And then, of course, the way Alan Greenspan did it was started printing money again, which eventually led to the dot-com bubble and then the 2008 crash, which was sort of Greenspan tightened again when he left. He did the same thing that Volcker did, tightened a little bit, handing it off to Bernanke. Bernanke really didn't know what the hell he was doing, especially in the early years. That's why you got into the problems in 2008.
Yeah, just kind of wrapping up here, if we could, Robert. So you see, based on everything we've done, inflation getting larger and increasing in the future. After that can come hyperinflation, and hyperinflation to me is a currency event. It's a lack of confidence in the currency, which would mean a collapsing U.S. dollar, something that could be a Minsky melt-up in terms of assets. Do you see that scenario as a possibility going forward?
Yeah, well, I think accelerating price inflation is pretty much in the bag at some point. Now, what I mean by that is, according to the government price indexes, there will be people that will dispute whether those are the most accurate ones. But I'm saying where they're now below 2%, you're going to have a jump to 3%. The Fed target is supposedly 2% inflation, and they're going to tighten if it's higher, but I don't. It'll go to 3%, and they're going to say, well, they'll justify that by it's just a little over our target, and it'll quickly go to 5%, and then at that point the Fed will take notice. I don't think they'll act very aggressively. They might raise rates, But if inflation is at 5% and they're raising rates from where the Fed funds rate now is 12%, not 12, 12 basis points. I don't know if I misspoke earlier. I meant 12 basis points, not 12%. And if they raise it to 2%, but inflation is 5%, that's going to be a large increase from 12 basis points to 2%, but it's still not going to be enough to fight off the inflation. Money supply will go, and it could very easily jump into double-digit rates. Hyperinflation is a little bit further down the road, and again, that would depend upon who is in charge at the Federal Reserve. There's a vice chairman at the Federal Reserve, a guy by the name of Stanley Fischer, who I believe is somewhat concerned about inflation, and he would probably call for a stop to aggressive money printing if it got at the 10% range for sure. But you never know who gets in as president, what their understanding of the Federal Reserve is, who they name as the Federal Reserve chairman, and you get another G. William Miller in there at the right time or the wrong time, and we're off to the races as far as inflation.
Any closing comments for our listeners that we haven't touched on regarding the Austrian School of Economics?
I would say the key is you really have to understand that this is a business cycle. There will be boom periods, there are going to be bust periods. People who think it's only going to be a bust are really going to, economists who claim the economy is always in a bust and you see things booming and things like that are not going to be believed. But so it's really dangerous if you don't explain it's a boom bust cycle. The importance is to explain when it's a boom period to people that, hey, this boom is not going to last. It's manipulated. It's Federal Reserve created. It's not being done for your benefit. It's being done for the benefit of the Wall Street banksters and also to support the Treasury debt. And at some point, they do tend to stop when the inflation does heat up, and that's when the crash comes. That was an important warning that should have been given before 2008, before the financial crisis, before the markets started to get weak in 2007. As a matter of fact, in my speech that I did give at the Federal Reserve, the two economists that were there were McCarthy and Peach, and they wrote in 2005 that the housing market was not in a bubble. And at that time, I specifically responded to their paper and said, you're absolutely wrong. You're making the greatest mistake since Irving Fisher in 1929 said stocks were never going to crash, that they were at a new high plateau. And they thought it was a joke and funny, and when they went around the country presenting their view that there was no housing bubble, they quoted me as an opposing view. So that's part of why I got into the Fed thing. I said, hey, looks like we got a crash here. Do you want to hear why it happened? So that's a good note to end on.
No, it's funny how many things that go around come around, isn't it?
Right. So it's important to emphasize boom bust cycle. Do not be fooled by the bust. Understand there are periods. Do not be fooled by the boom. It will end. Whatever's going up now does not necessarily mean it will go up long term. And the bust will occur, but they will generally be pumped out at some point by new Fed printing, and that's eventually where the inflation comes in.
Robert, how can our listeners follow your work, your writing, and your commentary? Sure.
The best thing to go is to go to economicpolicyjournal.com, and that's where I have steady commentary about the economy. There's a link there to Target Liberty. There's also a link to the Fed FLUNKS book that I mentioned, to Murray Rothbard's Austrian School Business Cycle Theory. There's a link to that book there. And anything else I'm doing, I mention. And if I'm doing a podcast on something, that's also mentioned there. So go to Economic Policy Journal and you'll get directed to anything I'm up to.
Robert, an absolute pleasure. Always enjoy talking to you, and we have to make sure it's not as long next time.
Yeah. Okay.
Talk to you again. Bye-bye.
Good talking to you. Bye, Gordon.